Well, welcome everybody. My name is Richard Weiner. I'm an attorney here at Fredrikson and Byron in the International Department, and I specialize in cross-border work and especially cross-border transactions with Canada. So I'm happy and pleased to see all of you in this topic, despite the awful weather. So we're going to talk a little bit today about these major topics. I'm going to touch on some of the legal aspects. Hopefully not going to bore you. I won't talk too long about legal aspects. And then we've got our friends from Toronto to talk about some of the tax and accounting aspects on conducting business in Canada. So let me start. So first of all, why Canada? Why do most American companies, when they start their first foray overseas, why do they go to Canada? Why not Brazil? Why not France? Why not Argentina? Well, I think the answer is pretty obvious. Canada is easy, it's very familiar, relatively easy. Distance, you get in your car, you drive a couple hours, you can be in Canada. So that's obviously very easy. In terms of travel, I mean easy to cross the border. There aren't a lot of regulations. When we Americans, I know we're sort of half Canadian, half American, I think, in the audience, but when we Americans go up to Canada, you stop, you show your passport, whether the immigration officer at the border stamps a Canadian business visitor's visa in your passport, he might not. Pretty easy, relaxed, you go in, easy access, easy exit, easy distances, and easy to get back and forth. The language, and I'll touch on this a little bit later, but we all know that most Canadians, and I emphasize most Canadians, speak English. Not all Canadians speak English, of course, because for those of you from the States in the room, yes, French and English are both official languages in the country nationwide, and we'll talk a little bit about French and French language laws a little later, but by and large, most people in Canada speak English. And although some of them have weird accents, we won't get into that right now, but pretty easy to understand and pretty easy to do business in the same language. Culture, very similar cultures, similar sports, similar music, similar products, similar theater, very similar culture. Legal system, also very similar, based on the English common law, of course, at least in most of the provinces. 9 out of the 10 provinces have the English common law tradition, as we do and most states do as well. Not Louisiana, for those of you who didn't know that. So 49 out of 50 states have the English common law tradition, as do 9 out of 10 provinces. So the legal system is pretty similar. Governments, I won't even start with Trump, but by governments I mean how powers are separated and balanced. So a judiciary, an executive branch, a legislative branch, not exactly the same, but Americans, we kind of get that. We get the separation, we get how the powers are distributed. Not exactly the same system in Canada, but something easy for us to easily understand. But it's not identical. It's not the same. So it ain't Kansas. It's not California, and it's not Wisconsin. And all due respect to our Canadian visitors, it's not the 51st state, because as we all know, Puerto Rico is the 51st state, or maybe one day soon to be the 51st state. But Canada clearly is not the 51st state. It is different, and you have to be aware of the differences. And as I go through this, I'm going to point out the differences, because a lot is similar, but a lot of Americans jump to the conclusion that it must be exactly the same. And there are some significant differences, and that's what I want to point out as I speak today. So first of all, the legal system. As I mentioned, based on the common law, English common law system, so everything, if you're American in the audience, everything your gut tells you about how our system works and how contracts are enforced and how courts come up with their decisions, what you've got in your gut, and that just from being a business person in the U.S., 95 to 98% of that is going to translate into Canada, but not Quebec. Quebec, of course, is based on the French legal system, so the Napoleonic Code, Civil Code, French Commercial Code, and so that's going to be a little different, and I'll talk about that a little bit later, but that means that some of the contracts may not be quite as enforceable in the same way, and some of the court decisions may not come down in the province of Quebec quite in the same way. And as I mentioned before, French and English throughout the entire country, official languages, and we'll talk about French a little bit later. Okay, so how are you going to go do business in Canada? It's a really big country. It's really big. It's bigger than the United States geographically. Most of the population, as you probably know, if even the Americans in the room know this, that a large large band of population is within 100, 150 miles of the American border, but the population centers are all spread out. That's the problem. Montreal and Ottawa and Toronto and Winnipeg and Calgary and Alberta and Vancouver, that's a huge distance you got to cover. So how are you going to do business with a population that hugs the border with the U.S., but is all spread out all over the place? So that's the challenge. Well, here's a couple options. Here's what you can do. You can do direct sales, and direct sales is basically selling from here. You go up to trade shows, you go up to exhibitions, you sell from here. You send people up from time to make sales or to help with servicing, but you do everything from here, and that's an option we'll talk about. Or you appoint a Canadian sales rep to go out and find you Canadian customers on location in Canada. Or you appoint a distributor to buy your products from you and then to resell them to Canadian customers. Or maybe you want to go it alone. Maybe you just want to open a branch office and dip your toe in the water. So you fly to Toronto, you rent some office space, you hire an employee or two, and you put out your goods and equipment, or you broadcast your services, and you've got a branch office in Ontario. Or maybe you find a Canadian company that sort of complements your goods and services, and you join up with them, and you establish a joint venture company, maybe 50-50, maybe not, but you find a complementary Canadian company and you start a joint venture company. Or maybe you go in whole hog all by yourself. Maybe you dive in the water head first and you just simply say, we're going to do this by ourselves and we're going to set up a subsidiary in Canada. We're going to set up our own corporation in Canada. And we'll talk about that because those are a little different, as you see on the slide here. There's federal corporations, but there are also provincial corporations, which are something that we Americans are not used to having to deal with. So we'll talk about that a little bit. And then this really strange corporate animal called an unlimited liability company, which exists in a couple of provinces, and we'll talk about that as well. Okay, so direct sales. As I mentioned, direct sales, you're going to do it all from here. You're going to go up to Canada when you have to. You're going to go up for trade shows and exhibitions and the like, but you're going to come back home. You're going to do it from here. Now, if you're selling goods and those goods are manufactured in the U.S. or Mexico, or they're brought in from overseas, but they're substantially assembled or installed or significantly changed in Mexico or the United States, then they may qualify as NAFTA goods. NAFTA, of course, the North American Free Trade Agreement. And if they qualify as NAFTA goods as they go into Canada, then in most cases there are no or very little customs duties or customs tariffs. It used to be we had customs duties, significant customs duties with Canada years ago. I'm old, so I remember that. You guys, no one's as old in the audience as I am, so look at this, really old here. So I remember when customs duties and customs tariffs were pretty high for Canada, but of course with the implementation of NAFTA, those have been rolled back in a lot of situations. I tell our American companies that want to make sales into Canada, do your utmost to try to transfer ownership on this side of the border, on the U.S. side of the border. And the reason for that is even though there may not be customs duties or customs tariffs once the products cross the border into Canada, Canada has an unusual system that we don't have for sales tax. There's a federal sales tax, which we don't, of course, we have state sales tax, but we don't have a national sales tax. But in Canada, there's a federal sales tax called GST, Goods and Services Taxes. And as well, in some provinces, there are provincial sales tax. So you get a layer of sales tax on top of sales tax. And I know our accounting friends are going to talk a little bit more about that. But if you transfer ownership, you transfer title of your products in the United States, that GST and PST, national or federal sales tax and provincial sales tax does not apply. So you, as an American company, you don't have to collect that from your Canadian customer, and you don't have to worry about being a sales tax remitter to Ottawa or to the provinces as well. So I try to keep it simple for our American companies and say, try to transfer your ownership here. Let them bring it into Canada, clear customs, and worry about that. Certain products still require government licenses or government approvals up in Canada, stuff you might expect. Medical devices, pharmaceuticals, there are others, but a lot in sort of the health field are going to require some government approvals. And now travel to Canada. So you're going to do this, like I said, direct sales. You're going to go into Canada when you need to. Visas are usually not a problem if you're going in for a short period of time. Like I said, you cross the border, you automatically get a business visitor's visa. You stop at the border, whether it's stamped in your passport or not, you have a business visitor's visa, just as our Canadian friends who came down may or may not have visas in their Canadian passports, but they are business visitors and they're entitled to stay under U.S. regulations as business visitors. Likewise, when we go up, the same thing. But two regulations I want to mention very briefly, and I'm not going to belabor it because they're very tax-oriented, and I know our Canadian accountants will talk about them more. But here are two regulations that usually throw American companies for a loop. Regulation 102 and Regulation 105. So let me start with 105. So Regulation 105 in Canada says, I'm an American company. I'm going, and I've got a Canadian customer, and I'm going to go into Canada. Me or one of my employees is physically going to go into Canada and provide services to my Canadian customer up in Canada. And let's just say that I'm going to do that for 2 weeks. And let's say that the Canadian customer is going to pay me a fee for my services. I'm going to go to wherever, Winnipeg, Toronto, wherever, and I'm going to provide these services. Well, Regulation 105 says that the Canadian customer has to withhold 15% of the fee and remit it to the Canadian tax authorities on my behalf, which kind of surprising. Most American companies don't realize that. So if you are a non-Canadian and you are physically in Canada providing services to a Canadian customer, then the Canadian customer is required to withhold on your behalf and remit part of your service fee to the tax authorities, unless you get a waiver. So there is a waiver system, and as Americans, you're entitled to a waiver because we have the U.S.-Canada Income Tax Treaty. So you're entitled to a waiver, but you got to get a waiver. Even stranger, I find, is, and more surprising for American companies, is Regulation 102. So Regulation 102 says whenever you send one of your employees up to Canada, and they're physically in Canada, and they're providing services, or they're going to a trade show, or they are looking for customers on your behalf, or whatever they're doing in Canada. Let's say I own an American company, and I'm going to send one of my employees up to Canada to show our products at a trade show for 2 weeks. Okay? Regulation 102 says that I have to, as an American company, I have to pay Canadian payroll taxes on the American salary of the American employee I sent up to Canada while he's physically in Canada. So even though I don't have a Canadian fixed place of business, and I just sent my employee up for 2 weeks to work with a Canadian customer or to meet with a potential Canadian customer and show my products and maybe make a sale, I have to, for the 2 weeks that my employee is in Canada, I have to pay Canadian payroll tax. Go figure. Unless I get a waiver. So you can get a waiver again because American companies are entitled to a waiver, U.S.-Canada Income Tax Treaty, but you got to go get a waiver. And so a lot of American companies are surprised at these regulations because you just don't think of it, right? Or maybe you don't want to do direct sales. Maybe you want to appoint a Canadian sales rep. Well, Canadian sales reps are governed by the Civil Code, Contract for Services. You, the American company, are considered the principal. Your Canadian sales rep is the agent. The agent cannot conclude business on your behalf. That is, they can't make deals. They can't bind you. They're not supposed to bind you. So just to be clear, a sales rep under Canadian law, and I want to pause here for a minute. Under Canadian law, there's a bright line distinction between what a sales rep is and what a distributor is and what a partner is, et cetera. And I know in the real world, in your world, not in the legal world, but in your world, those terms are very interchangeable. I got a sales rep in Canada, I got a sales agent in Canada, I got a partner in Canada, I got a distributor in Canada. I hear stuff like that all the time. But under Canadian law and American law, though there are bright line distinctions. So a sales rep always takes orders, never takes ownership. So your sales rep in Canada never takes ownership of your goods, ever, not ever, never. If he, she, or it does, they're not sales reps. Okay, so they don't take ownership; they take orders, and they put you in touch with a potential customer in Canada, and the Canadian customer pays you directly, and you give your products, you sell your products directly to your Canadian customer, and your Canadian sales rep usually gets a commission from you, which is oftentimes based on a percentage of the purchase price that the Canadian customer pays you for the goods, the Canadian customer that your Canadian sales rep found for you, and so you pay a commission typically after you get paid the purchase price from your Canadian customer, and that's usually the way it works. You want to be careful here under Canadian law for a couple of reasons. One, you want to make sure that your Canadian sales rep is not a permanent establishment for you. And by that, I mean a permanent establishment means that if the tax authorities in Canada deem that sales rep, he, she, or accompany it, to be your permanent establishment, then you have the privilege of paying Canadian federal and provincial corporate income tax. So you want to avoid this. And one of the tests used for this to determine whether you've inadvertently created a permanent establishment in Canada for which you get to pay income tax, corporate income tax, is whether the sales rep has the ability and uses the ability to bind you, legally bind you, whether it's signing contracts on your behalf or verbally binding you to obligations. You want to make sure that your sales rep can't do that, because if they do, you may run the risk of having that sales rep be your permanent establishment in Canada. The other thing that sort of blindsides American companies is that the sales rep could, under Canadian labor law, be considered to be an inadvertent employee. So you've got a Canadian sales rep, let's say it's a guy, it's just it's not a company, it's a guy. And the guy reports to your American company's vice president. You are his only client. He works for you 9 to 5. He takes orders from your vice president. Maybe in addition to a commission structure, maybe he gets a monthly stipend for his expenses. Under Canadian labor law, the rule is if it looks like a duck and it walks like a duck, it's a duck. And so all of those indices that I just mentioned look like an employee, working 9 to 5 for the same employer, getting something that looks more like a salary, a stable salary, monthly salary, and maybe a bonus. So it doesn't, all of those indices under Canadian labor law say employee and not sales rep. And Canadian labor courts really don't care what you call the guy, and they really don't care what the title of the contract says. So if your contract says sales rep agreement, but look, Your Honor, it's sales rep agreement, that doesn't matter. If you're treating him like an employee, he's going to be an employee, and you don't want an employee because that gives him additional benefits under the labor laws in Canada. You'd much rather have a sales rep. Termination. So to terminate a sales rep in Canada, you can't automatically terminate. You have to give what's considered reasonable notice, and that's going to vary depending on the years of service that he, she, or it, and it I use for the company, was your sales rep in Canada, and the amount of investment they've made to be your sales rep in Canada. If you terminate without sufficient notice, you can be liable for damages, which could be compensation for the services as well as loss of income to the sales rep for your unilateral unjust termination and loss of any opportunity that they may have had you not terminated them in the first place. Or maybe you want to appoint a distributor instead of a sales rep. Now, there's no federal law for distributors, only provincial law for distributors, so it varies a little bit, not much, but a little bit from province to province, but by and large, it's the same definition in all the provinces, and that is a distributor buys products from you, takes ownership, turns around, marks up the price, and resells your product to the end user. And that's how the distributor makes its margin. So they buy products from you. So if they buy products from you, they're distributors. If they don't, they're more likely to be sales reps. And they can resell them at any price they want. Again, for termination, you just can't walk in and terminate a distributor. The distributor gets reasonable notice of termination, again, based on years of service as your distributor in Canada and the investment they've made in distributing your products throughout the country. If you terminate unilaterally and you don't give appropriate notice, then there can be damages, usually actual and foreseeable damages that the distributor can prove in court. Or maybe you just want to go it alone. Maybe you don't want a Canadian sales rep and you don't want a Canadian distributor. You want to go alone. So you get in your car and you drive to Toronto and you lease some office space in Toronto and you hire an employee, a Canadian employee, and you put out your goods or you broadcast your services and you wait for folks to walk in the door and buy your stuff, which you can certainly do. If you do that, you need to, first of all, register in the province where you want to do business. As a U.S. entity, the company back home here in Minnesota has to do a lot of the same filings, complete a lot of the same forms as regular Canadian companies have to do, which can include federal reporting financial reporting on the federal level in Canada of your company back in Minnesota. So you have to be a little bit careful about exactly what you want to disclose if you're going to have a branch office. And maybe the most important issue here legally is that a branch office is not a separate entity. It's an extension, if you will, of your Minnesota company. So if you have an employee in your Canadian branch office in Toronto and I walk through the door and the your Canadian employee says, you see this device, see this clicker here, this cures cancer. And I say, great, I'll take 20. I've never heard of such a thing. And of course, this doesn't cure cancer. So I go home and doesn't cure cancer, and I sue. And I sue your Canadian branch office for wild, outlandish claims. And I win. And you say, no, wait a minute, I'm in Minnesota. You can sue my Canadian branch office, but you're never going to get my assets back in Minnesota. Those aren't at risk. Wrong, they are, because as I said, your branch office is not a separate legal entity. So now that the disgruntled customer that I am, and I've sued you in Canada, now I can enforce that judgment in the United States against your home country assets back in Minnesota. So you've got to be careful with a branch office. Likewise, if your product, I picked an outrageous, example of outlandish claims, but if your products are defective, and I sue you up in Canada for defective products that I bought at in your branch office, your home country assets back in Minnesota or wherever you are in the States are at risk. So you've got to be careful with the branch office. Or maybe what you want to do is you want to jump in and you just want your own subsidiary. So you're going to do this on your own, incorporate a corporation in Canada. This is indeed the most common form, as you might imagine, of doing business. Everything that you know about corporations, not everything, but almost everything you know about corporations in the U.S. sort of applies with some twists and turns in Canada, and we'll get to the twists and turns in a minute. But the Canadian Business Corporations Act is not too dissimilar from the U.S. Uniform Corporations Act. So very similar structure for corporations, boards of directors, officers, how decisions are taken, operations from a legal standpoint, pretty similar stuff. No minimum or maximum capital requirement to incorporate, just enough, you just need to put in enough funds to keep the corporation up and running. And one major difference is the type of incorporation you choose. Now, of course, those of you who are American in the audience know that in the U.S. you've got to pick a state. Minnesota Corporation, New York Corporation, Wisconsin Corporation, Florida Corporation, whatever, but you got to pick a state. Not so much in Canada. In Canada, you can pick a province. That's not a problem. You can certainly do that. Or they have something called a federal corporation. And so you can pick a federal corporation. And there's really an art and a strategy to figuring out whether you should be a federal corporation as opposed to an Ontario corporation or a British Columbia corporation or a Quebec corporation. So there's real art and strategy to it. And so I won't get into the details of that. Some sectors have to be federal, so banking, transportation, communications, a lot of those need to be federal corporations. You don't have a choice. But unless you're in one of those very limited sectors, you got to your first threshold question doing business as a Canadian corporation is, do I want to be a provincial corporation, or do I want to be a federal corporation? Now, one thing that we're not used to as Americans, because this doesn't exist in a lot of the states, is that several of the provinces have residency requirements for its board of directors. So a certain percentage, usually 25% of the board members, have to be resident in the province where your corporation is incorporated. And if you're a federal corporation, 25% of your board members have to be Canadian residents. So we're not really used to that. So if you don't, and we'll talk a little bit about what you do if you don't know, if you want to set up a corporation in Canada, but you don't know any Canadian residents in that province or federally that you want to put on the board or that you trust to be on the board. And we'll talk a little bit about that in a minute. But Canada has a similar system to our system if you want to do business in more than one province. So let's say you are a Manitoba corporation. You've incorporated in Manitoba, but now you want to open up an office in Toronto. Okay? Sort of similar to being a Minnesota corporation, but now you want to open up an office in Los Angeles. You open an office in Los Angeles, and as many of you probably know, you have to qualify to do business in the state of California under California law. And it's relatively easy and a little administrative, but no big deal. You file documentation with the state of California, and you are qualified to do business in California as a non-California, or what we call here, strangely enough, a foreign corporation, but it's a U.S. corporation doing business in California. In similar fashion with my Manitoba corporation, there is the same process to qualify to do business in Ontario. It's a little bit of a different system, but by and large the same concept. In Canada, it's called obtaining an extra-provincial license to do business in a different province, but similar system. Doesn't take, relatively easy, doesn't take very long. Pretty easy to accomplish. Well, I want to spend a couple of minutes on this strange animal that we don't have here at all that is actually quite popular among American companies that do business in Canada, and that's an unlimited liability company. Yeah, you heard me right, an unlimited liability company. So an unlimited liability company, as the slide suggests, is not a limited liability company. Limited liability company, for those of you who don't know, means that, and we have them in a lot of states here, the LLCs, the Minnesota LLC, Delaware LLC, Oregon LLC, whatever, and that basically means that as a shareholder, your liability is limited to the amount that you have put into the corporation. So pretty straightforward. Limited liability means that they can't get at your corporate or personal assets above and beyond what you've placed into the corporation. That's not what an unlimited liability company is in Canada. An unlimited liability company actually means that each of the shareholders are jointly and severally liable for all of the debts and the claims of the unlimited liability company up in Canada. So upon liquidation or insolvency or bankruptcy, you as the shareholders of that unlimited liability company are personally liable for all of the debts, not divided up by the number of shareholders, but each one of you is liable for all of the debts. So why the heck would anybody ever incorporate an unlimited liability company? Well, there are good tax reasons, and again, I won't go delve into them too much because I know that Stan and Steve are going to talk about it. But the best reason for American companies is that there are U.S. tax advantages to doing so. It's the only, to my knowledge, and our Canadian counsel will correct me if I'm wrong, but to my knowledge, it's the only Canadian corporate vehicle which will allow you in the U.S. to, in essence, check the box for tax purposes. It's a pass-through. It's a flow-through. It allows you to consolidate the, I don't know if consolidate is the right word, and I'm sure the accountants will be yelling at me in 2 seconds, but it allows you to pass your losses up into the U.S. and to take foreign tax credits in the U.S. It's available in 3 provinces only, Alberta, British Columbia, and Nova Scotia, but Alberta has residency requirements for its directors, and I think it's 25%. So if you don't know an Albertan that you want to put on the board of your new Alberta Unlimited Liability Company, then you've got British Columbia and Nova Scotia to talk about, to use. As I mentioned, it's a disregarded entity for U.S. tax purposes, and your losses pass through. Now, here's the kicker. Here's the problem. So you incorporate, let's just say, a British Columbia unlimited liability company, but there you are. If that company has debts and obligations, you as the parent company have to assume all of them. There's no legal protection. So I sue your British Columbia unlimited liability company for $10 million and I win. And you're back in Minnesota saying, well, go at it. That's in British Columbia. And I say, hey, baby, guess what? Unlimited liability company, you're the shareholder. You get to pay the $10 million from Minneapolis. Okay, so what American companies do is we put in a blocker corporation in between. So if you can imagine, the top tier is your Minnesota corporation or your American company, wherever you're incorporated. And on the bottom tier is your new British Columbia Unlimited Liability Company, that's the one that's going to be doing business for you in Canada. And in between, we interpose an American LLC. Delaware LLC is not uncommon, Minnesota, New York LLC. And the reason we do that is because the LLC will do nothing more than hold the shares of the British Columbia Unlimited Liability Company. That's all it will do. And so when I sue your British Columbia Unlimited Liability Company for $10 million, your Delaware Limited Liability Company says, well, that's great, but that's all we got. We just own the shares. And worst case, you bankrupt the British Columbia Unlimited Liability Company, you bankrupt the Delaware Limited Liability Company, but because it's a limited liability company, that's where the damage ends. you have no exposure to your assets back home in Minnesota. So you put a U.S. blocker corporation in between your company back in the U.S. and your new British Columbia unlimited liability company. I'm going to spend 2 seconds on employment in Canada, because now you're going to have a Canadian company and you're going to be hiring Canadians. So employment standards in Canada are governed by provincial law. So minimum wage, vacation, overtime, leaves of absence vary a little bit from province to province, but by and large, not dissimilar to what we have in the U.S. Canadian labor law allows for restrictive covenants, but they're frowned upon, so narrowly enforced for non-competes, non-solicitations that you impose on your Canadian employees. Unlike in the U.S., Canadian labor law is not at-will employment. So here, let's say I work for your company and I'm not doing a real good job today, and as long as I'm not in one of the federally protected classes in the U.S., and you know them, I'm sure, gender, race, religion, sexual orientation, et cetera. If I'm not in one of those, age, and I am in the age, look, right, old, so I'm actually in the protected class for age. But if I weren't in one of those, you could walk in as my CEO and say, Rich, I'm terribly sorry, but things just aren't working out. So maybe this week ought to be your last week. And in theory, and I guess sometimes in practice that happens. Or you could walk in and say, Rich, I'm sorry, but we're having layoffs, and your name is on the list. We've got to let these, we're not doing well. We have to let these 20 people go, and so I'm afraid this is your last week. And I'd say, well, okay, I'm not in a protected class, at-will employment. I guess that's just the way it goes, but not in Canada. In Canada, you have both under common law and statute, you have minimum notice requirements for termination, and it's typically 1 week of notice for every year of service in the company, up to 8 weeks. So you couldn't walk in. If we were in Canada, you couldn't walk in and do that to me. You'd have to give me notice. Or if you didn't want to give me notice, you could buy me out of my notice period. So if I had worked for you for 8 years and I was entitled to 8 weeks of notice, I could come to the office and sit on my hands and collect my paycheck for 8 weeks. Or you could say, look, Rich, don't hang around. Here's 8 weeks of pay, and I'd be done. But not at-will employment. Now, I'm going to skip, just for the interest of time, because I know we're going late, I'm going to skip intellectual property. These slides are sort of for like a 45 to 60-minute presentation. I'm trying to talk really fast. Can you guys tell I'm from New York? We're talking really fast. So I'm going to skip IP, but I'm happy to discuss IP if you have any questions. IP is a little different in Canada. We can talk about that offline if anybody's got any questions. But I wanted to end with French labor laws, because I'm always amazed how Americans, especially on this side of the country, nowhere near Quebec or New Brunswick, completely forget that there are French. They know that there's French up in Canada somewhere, but there are French labor laws. So this slide says, Bienvenue au Canada, parlez-moi en français, au Québec, le français fait loi, which means welcome to Canada, speak to me in French. In Quebec, French is the law, and they're not kidding. So in Quebec, they enforce their French language laws under something called a Charter for French Language, which means that every person in Quebec has the right to do business in French and be served in French and be informed in French. So if you are going to have or you're going to try to get Quebec customers, or you're going to try to advertise nationally, you have to think about French. Okay? So all of your boilerplate contracts, your terms and conditions, have to be in French. Any standard contracts that you automatically have to be in French. If you're going to actually negotiate a one-off contract with a Quebec customer, that has to be in French. Okay? But with a one-off contract, the customer has the right either to demand that the negotiations be held in French and that the contract be drawn up in French, or they can waive that right. And if they waive that right, because you say, wait a minute, I'm not going to do this in French. I know you're in Montreal, but I'm not going to do this in French. They have the right to waive their rights to French, to have the contract negotiated in French and drawn up in French. It's magic language that has to be in the contract. It's absolute magic language in French and in English that has to be in the contract. And if it's not in the contract and something goes south with the contract, then your Quebec customer has the right to try to nullify the contract because you didn't comply with the French language laws of Quebec. So when I say everything in French, I mean everything. Advertisements, order forms, invoices, receipts, all in French. It can be in English and French, but it has to be in French. Websites, in French, all of it. And even if you're going to do business nationally, but you're trying to attract Quebec customers, in French. Warranty certificates in French, packaging in French, software in French, unless there's no software version in French. But by and large, don't forget French. So I want to highlight, just to wrap up, I want to highlight a couple of the major differences because so much of it is similar. But just as a quick recap. So doing business in Quebec is the French Civil Code and the French Commercial Code, not too similar to our system. So you need to be careful when doing business in Quebec. 2 levels of sales tax, federal sales tax, and in many provinces, a provincial sales tax as well. When you incorporate, you have to make a decision between a federal corporation and a provincial corporation. Like I said, there's an ardent strategy to that. Residency requirements in some provinces, 3 or 4 provinces for directors who sit on the board of your company in Canada. The unlimited liability company that I mentioned, that strange animal that a lot of U.S. companies actually do use when they incorporate in Canada, including that blocker corporation I mentioned. Termination of employees is not at will, so not at will employment in Canada, to be careful. I'll skip the ones for IP, but I'm happy to talk about moral rights later. Regulation 102 and Regulation 105 I mentioned. And finally, don't forget French for your customers and potential customers in Quebec. And with that, I'll stop and happy to answer any questions at the end of the presentation.
Hi, I'm Stan Zinman.
Stan.
Sorry.
Rich, quick question. We talked about forms of doing business in Canada, joint venture, but one of the others obviously is buying a company there. Anything tricky due diligence-wise or anything if you're going to buy a Canadian company?
Yeah.
The accountants laugh. But okay.
We're all laughing. Yes, but I think
cover that.
let's save it till, let's save questions till the end. Just
okay.
In the interest of time, but
that's
happy to answer that. I'm sure Stan and Steve want to weigh in.
Yeah, that's, I don't even cover it in my presentation. That's a whole subset or subsector,
right.
But you're right. That's a very common event, and there's ways to, I might actually address some subtleties that should be in terms of repatriation strategies when you're buying a Canadian company. But I digress. I'm Stan Zinman. I work in the Toronto office of BDO. Jeff works in the Minneapolis office of BDO, and thank you very much for having me down here. Rich, that is an incredible presentation, and I've never met Rich before, but man, you know your Canadian corporate, like, wow. I am extremely impressed. I talk quickly too. Really fast. But that was an extremely informative session. That is, you certainly know your stuff. I guess the other comment I can make just before I delve into my presentation is that I am actually, although I live in Toronto, am actually from that province, Quebec, where you're supposed to speak French. And I could tell you stories. I left Quebec. A lot of English guys did, or we call it only in Quebec, even the guys in Ontario. You're actually divided between Anglophones, such as myself, who are English-speaking, and my mother was born and will die in Quebec and has never spoken a word of French in her life, and there's actually a very vibrant English community, the Anglophone community. And then there's the Francophone community, which was the founding community and remains a very dominant community and controls the province politically and whatnot. The two collaborate very well, but I could regale you with stories about this French-English nonsense. The sign law, for example, it's not only simply that they have to be the sign has to be in both French and English. The French has to be twice as large as the English because it is the predominant language. But I think you might have seen stories about that on 60 Minutes and whatnot. Anyways, okay, I just killed it. Sorry. What did you? Oh, you this thing is,
I don't know about that. Does that? Yeah, there you go. It's
okay.
That one.
Oh, that one. Thank you.
All right. All right.
Okay. Briefly, I'm trying to give you a pretty high-level overview of the Canadian tax system. Rich did a really great job. If I had known he was doing that thorough a job, I could have come here and spoke for 3 hours about every issue that he addressed. But anyways, time does not permit for that. I'm going to quickly give you just a sense of what the income tax rates are and the withholding tax rates are. And of course, that's become very topical lately with Trump and tax reform in the U.S. because, as you may have heard, the U.S. tax system, I'm not a U.S. tax practitioner, but I can speak to it at a very superficial level. U.S. companies pay the highest federal tax rate anywhere in the world other than Japan or something like that. You're in the high 30s. Canada's tax rate, just for your information, our headline rate, if you will, depending on what province you do, is roughly 25 to 26%. With talk of Trump tax reform, 15% rates, who knows what not. That is certainly going to change the way we try to structure investments by U.S. companies into Canada, because there was obviously a huge incentive for a U.S. company to try to avail itself of the lower tax rate in Canada. And that's really what the problem was competitively and why Trump was so upset, or the Republicans are so upset with the federal or the corporate tax rate that you guys have. So a lot of the planning that we've been doing over the years, and this imbalance has been in place for over 10, 15 years now. The Canadian corporate tax rate used to be extremely high as well, but we lowered ours about 10, 15 years ago. And just so you should know, most of the rest of the world is more in the 25% rate, not the 39% rate or the 35% rate. So a lot of the planning that we do, depending on where this shakes out in terms of Trump tax reform, is very topical. And we'll have to keep our focus on that, or our eyes on that. In fact, when you try to play between countries and arbitrage corporate tax rates, Kirk Hester from our Chicago office is here at BDO, and he's actually a transfer pricing expert. And a lot of the planning and the play that goes on between the jurisdictions globally involve a lot of what we call transfer pricing, which is a very specialized area where you try to, for lack of a better expression, manipulate the value of certain services and goods between the countries, depending on where you want the profits to end up. So again, there has been a bias of late to have profits reside in Canada or have them taxed in Canada, contrary to what Rich may say, because you want to avoid taxation in Canada, but there may be a benefit to taxation in Canada, and that may all change depending on where tax reform comes out. I'm also going to talk about Reg 105 and Reg 102, which Rich did as well. And of course, you couldn't talk about Reg 105 and Reg 102 since a lot of companies are really offside on that. And we spend a lot of time doing that. Our amnesty program is called a voluntary disclosure program. We spend a lot of time helping U.S. companies out who've been offside, inadvertently, whatnot, going forward to the tax authorities. It's called the VDP, the Voluntary Disclosure Program. It's an amnesty of sorts. By going up front to them, you get to eliminate a lot of penalties and interest that might be associated. It's unlikely, though, you'll actually get away from the core tax. You may be able to recover some of that core tax under certain things. And as he was alluding to, or Rich was alluding to, when you first enter Canada, I will tell you, or you may have been doing business inadvertently in Canada and actually been exposed to these things. And then when certain things occur, you may suddenly fall into the Canadian tax net, and you should be wary of it. And we spend a lot of time using this voluntary disclosure program, trying to retroactively clean these things up. One of the things is, as Rich so deftly pointed out, if you decide, hey, I want to register for the GST in Canada, which Federal Express may inadvertently do for you without your knowledge and whatnot when they're bringing goods in because they don't want to be the importer of record, then you run a risk of falling into the tax net and all these other things suddenly fall out. And by the way, that's probably one of the most often things when you buy a Canadian company, when we're doing the due diligence, we'll talk about it briefly, it's these kinds of nagging liabilities that are in there, and many of them do not become, quote unquote, in tax terms, statute barred because you actually never complied. It can actually kill a deal because you'll find there's all these unknown, or we'll go in and do a voluntary disclosure and it'll delay a deal because we'll try to just cleanse the company. I'm also going to talk about the tax consequences of a lot of the business entities that Rich spoke to. I'm going to briefly talk about acquisition planning, and hopefully, if we have time, some questions, or perhaps after Steve has finished his presentation. I don't want to sound or make this pedantic, but I do get asked this a lot. So in Canada, we have provinces. They're not states, they're provinces. We have 10 provinces. We actually have 3 territories. I'm old too. We used to have 2 territories. So now we have 3. None of it joined or came in, or I think one of the territories split itself up. And in this, not so dissimilar from your U.S. system, the federal and the provincial governments each have taxing jurisdiction. So the federal tax will apply throughout Canada. I'll talk about that tax rate at some point. And each province has its own right to tax. And our provincial tax rates are pretty high. And you'll see on one slide, I try to give you some of the rates and whatnot. And basically, it's not that dissimilar from your U.S. concept of state tax or why you're subject to tax in a state. It's kind of like Nexus, not exactly like Nexus, but we can actually help you out in that. But something that you should bear in mind, because it's unlike the U.S. federal system, is that our federal tax system does not allow you to deduct the provincial tax when computing the tax. So you just merely, it's not like, oh, there's an after-tax arbitrage with the provincial tax component like there is in the U.S. with the state tax. Thankfully, and this has evolved over the years, all the provinces, there's only 2 holdouts now, Alberta and Quebec, have a collection agreement with the federal government, and therefore You need only file tax returns federally, and as long as you're not in Alberta and Quebec, you will have no provincial tax filing requirement. The federal government will collect it on behalf of the provincial government. The tax system is the same, and that eliminates a lot of compliance burden, obviously, for companies. I often joke because I know that when I'm quoting on a multinational that's coming into North America, in the US you could end up filing in God knows how many states and federal returns, and the minimum price could be like $75,000 because you could be in 20 states with all these filings. And then they come and they say, okay, now how much is the Canadian likeness going to be? I'm in a fortunate situation where more often than not I only have one return, maybe an Alberta return. Just briefly, and Richard alluded to it as well, corporations that are set up in Canada, and we're not talking, it would apply to branches too, let me go back. But the basic tax system in Canada is the federal income tax, the federal goods and services tax that Rich alluded to, and that's called a GST, goods and services tax, or you'll often see the expression now called HST, which is harmonized sales tax, because a lot of the provinces chose to just piggyback the federal tax, so and actually adopt the same mechanism. It's more of a what we call a value-added tax, similar to the European way. So you'll often see GST, HST interchangeably. Ontario, for example, chose to piggyback. We only have an HST. Quebec has to be different, so they'll still have a GST and a provincial tax, although it's somewhat harmonized. The only province that still hold a real shock, actually, was British Columbia, which still actually administers its own provincial sales tax as well. You should be mindful that corporations are subject to Social Security taxes, that's sort of payroll taxes, if you will, similar to your FICA situations. And of course, there's provincial taxes, which I just spoke to before. So, what makes you liable to Canadian tax? Now, and this is where we talk about branches when you make a decision that you don't want to incorporate in Canada yet. Because once you incorporate in Canada, and I'll talk about it in a later slide, once you've incorporated, you've given up. You are liable to Canadian tax. That company is taxed on its worldwide income, and there is no getting out of the Canadian tax. But what if you say, hey, I don't want to go there yet, I don't want to deal with that yet. Then we talk about, well, what would make a foreign branch, a foreign company subject to Canadian tax? And I know this is a bit dry, but it's really basic primer stuff. You become taxable as a non-resident in Canada if you're employed in Canada, if you're actually coming up here. More importantly, and for the purpose of this discussion, you're carrying on business in Canada, and or you actually dispose of taxable Canadian property. And that is actually very relevant, maybe not so much, but you'll often have foreign companies that own large commercial projects, rental properties, and whatnot. That's the classic taxable Canadian property. Canada, even though you're not carrying on a business in Canada, you're merely earning rent. When you turn around to sell the property, Canada retains its right to tax it, as the U.S. would under its FIRPTA regulations. But for today's discussion, let's focus on carrying on business in Canada. What you should know, and it's important, is carrying on business, the threshold to fall into that under our domestic law is a very low threshold, a very low hurdle. And it's based on antiquated common law tests, and it talks about where contracts are concluded. It's back in the days of bricks and mortar and things like that, where your place of operations are and from which profits arise, et cetera. So that all could subject you as a foreign company coming into Canada, even though it doesn't really sound like you're really carrying on a large business, you could fall into it under our domestic law. Now, and I'm expanding a little bit. I mean, this is how antiquated. If you produce, grow, mine, create, manufacture, you're all considered solicits or offers anything for sale in Canada. Many companies do that. U.S. companies do that through an agent or servant. But you should know, at least in the context of today's discussion, and in terms of Canadian taxation and the U.S. taxation worldwide, we have something called tax treaties. We have a very, very rigorous tax treaty between Canada and the U.S. since the level of trade activity that occurs between the countries. And that's designed to eliminate double tax. That's really what an income tax treaty is supposed to do. And that treaty will often override what I just described as your domestic law. In other words, you will not have a taxation in Canada or a liability to tax in Canada, because under the treaty, it's a much higher hurdle to have something that we call a permanent establishment. That is a much higher rigorous thing, and I'll just allude to that. So a PE, unlike just merely carrying on business through a branch, is a fixed place of business, and it's a logical way of looking at it. It looks at an office, but it does not look at some agent who is operating out of his home, so long as the U.S. branch, the U.S. company, does not control those premises. But once the U.S. company decides to rent space in Toronto and carrying on business, or a warehouse or things like that, or a manufacturing site or construction and things of that sort, then you're looking at, yeah, that foreign or U.S. company has what we call a permanent establishment under the treaty too. And it includes, as I just said, a building site, a construction installation person, project lasting more. These are defined issues in the treaty, or some treaties say 6 months. The Canada-U.S. treaty is 12 months. Where we're seeing a lot of that now, of course, is the level of high tech and tech consulting that occurs between the two countries, and you just see this constantly now. And that includes, and it's very important for you to know if you're in that space, computer installations. That is considered a construction or installation type project. And if it's going on for a while, like more than 12 months, and we'll talk about it because they actually recently amended the treaty to make it even easier to fall into that, those types of installation projects could cause a permanent establishment for your U.S. company and all the Canadian filing requirements. And what I'm really trying to get at is if, in fact, you are going to have a permanent establishment in Canada, no matter what you do, you may well consider setting up a company. Because there are benefits then to have a company conducting your business in Canada in terms of commercial matters. Just dealing with the public at large in Canada, they would prefer to deal with a Canadian company. It's easier to sue a Canadian company. You know who it is. As well, there are those withholding taxes that he just alluded to earlier, the Reg 105, namely that 15% withhold. And in these installation situations, that could be fatal. Because if you don't have that Canadian customer paying a Canadian subsidiary that you chose to set up, you're into that 15% withhold under Regulation 105. And although Rich alluded to waivers, they are very hard to get these days. In fact, we don't even talk about getting them. So it's really a cash flow burden. 15% gross withhold on your service revenue, on your gross, and then you're actually in a position more likely than not where you may file a return. And if you didn't have a permanent establishment, you can file the return in the year, a corporate tax return, a basic Canadian corporate tax return, and get the money back. But that's a big cash flow. That could take 9 months. All right. And of course, the classic old traditional one where a sales agent coming into Canada, and you know, this last item is actually easy to get around. You just make sure the guy doesn't actually conclude contracts in Canada. He doesn't have authority. Technically, it has to be signed off by head office. These are things that you can manipulate, you know, and make sure that you don't fall in. So the guy comes up, but he makes sure that the contract is entered into outside of Canada, or he's otherwise has to be, you know, approved. It's not just a rubber stamp back up in the U.S. parent. I'll also tell you, on a go forward, the world at large is very annoyed by the ability to get around taxation in another country by just having the guy, you know, pretend not to be the actual ability to conduct this thing. And you're going to see, and I'm only going to talk about it once, there's a whole worldwide initiative out there called Base Erosion Profit Shifting, BEPS. And that is very much focused on ending the ability to avoid Canadian or local domestic taxation by just rigging your sales agents to say that they're only really just an agent and they don't really conclude on your company, just so you should know. Okay, so now you're under the treaty, and you're entitled to the treaty as between your U.S. company carrying on business in Canada, and it's very, very specific that you can get outside of the PE under certain exceptions, which is very relevant because more often than not, we try to fit that. So if you're not owning the warehouse, but you're actually, and it's somebody else's warehouse and you're just storing goods there, that's a good one. And then you go through all the various exemptions. The collection of information in Canada shouldn't cause you to have a PE in Canada, merely advertising, supplying, or scientific research that is only prep or secondary to the business, et cetera. And then the final exclusion would be a very often used one is if the non-resident, in this case a U.S. company, uses a Canadian broker or general commission agent, which Rich spoke to before, then you may well get outside of the permanent establishment net. More recently, in our most recent Canada-U.S. treaty, despite all this exhaustive activity, we brought in a pretty archaic thing, and it's the service providers. And it's a lot of these high-tech guys or guys coming up here. And a lot of these companies kind of treat North America as one unit and are really not, and it's a nightmare often to just, you know, undo it. But they'll just send employees, you know, willy-nilly to, okay, well, you have availability, you're going to Vancouver today, or today for a few weeks or a week or whatnot. And now historically you could do that and not fall into a permanent establishment so long as that person wasn't working at the U.S. parent's premises in Canada, didn't have a premise in Canada. And there was a very good case that actually concluded that even though the guy worked for one of the major oil companies in Alberta, and he basically had his own office, and he was there for over 2 years, because he didn't control that office and didn't have a key to the office, and the name of the case was Dudney, the U.S. parent was not subject to tax in Canada. because he was not considered to be a permanent establishment of that company. And that's why they brought in all these rules. Now, I'm going to really get behind here, and I'm just going to allude to it, and you can read the slide at your own leisure in the handout or whatnot. But just to be mindful now that there's actually sort of very dicey rules now that even if the guy doesn't control the premises in Canada, that consultant that came up to work for Nova in Alberta in the oil patch or whatnot, once he goes over 183 days, he causes the U.S. parent to have a branch. It's the deemed service provider provision under Article 5. And then there's a secondary test as well. And again, it's just looking where to try to get taxability, and Canada didn't like the outcome of the study decision. Other situations where, and again, even though you might only have a small contract or you're doing it for a major Canadian bank in different cities, that can all be considered one large contract. So even though each contract is less than the 183-day rule in Toronto, when you start adding it up and it's the same people, then they look at it that way. And it's really, really something we're really, even though it's, this new protocol has been in place now for about 8 years, a lot of people are just getting up to speed with it. Okay. Now, just quickly, if in fact you've successfully, under the treaty, not had a permanent establishment in Canada, I will alert you to basic stuff that you still have to do. We call it, you're basically taking a treaty position under the Canada-U.S. treaty that you do not have a permanent establishment. But please remember, not unlike the U.S., if you were doing it conversely, you still have to, or are obliged to file a Canadian federal income tax return asserting that position. And if you don't, now our penalties aren't nearly as egregious as the U.S. penalties if you were to fail to do so under the U.S. regime. It's only $2,500, but for every year, and it starts to add up, and often companies come to me after they've been doing business here for 10 years. It's a lot of money. And we do a lot of voluntary disclosures under this to try to get you out of it, you know, and generally most of these voluntary disclosure / amnesty programs only let you do it once. So you get one shot at it, you do it, and but don't do it again, all right? And on the other side, those treaty-based returns are could often be beneficial to you if you were subject to those 105, Reg 105 withholdings, because that's how you get the money back. And you should be mindful, if you were not aware that your actual customers in Canada were withholding from you, that those refunds can only be gotten within 3 years. In other words, after a certain period of time, and you haven't filed on a timely basis, they're not going to give it to you, and that's unfortunate because that's found money. Just so you should know, it's a big difference between U.S. and Canadian taxation. I'm just trying to highlight it here. In Canada, unlike the U.S., we don't have consolidation. So you set up separate companies, you're not allowed to consolidate them. Each one stands on its own, and that's somewhat problematic for tax planning. Having a consolidation regime, as you do in the U.S., is quite beneficial. The way we try to actually consolidate, then, is we use partnerships owned by the same partner companies, and you set up multiple partnerships because you want to otherwise separate the commercial exposures in each. That causes or permits a consolidation. But prima facie, we do not have tax consolidation. And that becomes a hindrance when you're talking about loss utilization, where one of your companies may have losses, one may have profits, and you're often dealing with U.S. clients that are coming into Canada, they can't believe that they can't just consolidate this thing. Just so you should know, more often than not, you will probably come into Canada initially as a branch, and then at some point say, you know what, this is just getting too exhaustive and too large, and then you incorporate. You can incorporate on a tax-free basis, but the prior year's losses while you were running it in Canada as a branch don't fall into the companies, don't get carried into the company. So you should be cognizant of that, because the losses, the branch losses, are available to you so long against future branch profits. But once you incorporate, the two can't, again, because there's no consolidation. Another thing you should be very aware of, the last bullet point, acquisition of a Canadian company. Often there are losses in there. Generally, not unlike the U.S., once you've acquired control of a Canadian company that had losses, you must be very mindful because it's an acquisition of control, and there's very exhaustive rules designed to limit the availability of the new owners of this Canadian company to use those losses. That being said, unlike the U.S. rules, which are pretty restrictive over and above that because you're limited based on your price that you pay for the company in a specific percentage. There's no such limitation in Canada. If you're carrying on the same business, which is the basic concept, after an acquisition of control, you can use all of those losses. So that's pretty generous. But you should be mindful of the losses when you're deciding to do an acquisition. Because again, I didn't want to necessarily get into exhaustive discussion, but that is a substantial tax benefit and may lead you to want to do an acquisition of a company rather than just buy its assets. Some quick comments about tax administration. I'm going to just try to highlight what's very different to the U.S. The tax return for corporate purposes is due within 6 months after the fiscal year end. You can have any fiscal year end you want in Canada. If it's December 31st, yes, this is a very busy week for tax practitioners because June 30 is our deadline, unlike June 15 for you guys. But the most important thing is we don't have extensions in Canada, and I find that constantly running into that U.S. customers or clients coming in, BDO, yes, referrals. No, we do not have extensions. And you actually have to pay the tax that you may otherwise owe actually to avoid interest, not penalties, but interest within 2 months. So those are the relevant timeframes you're looking at. You want to try to get your balance of tax paid by the end of February if you're a December year end, but you also then must file the actual return within 6 months. And if you don't, there's a 5% flat late filing penalty on tax owed. So if you make an installment in respect of your tax liability, you're going to mitigate a lot of that late filing penalty. I would discourage anybody from filing late. Filing late is a trigger for audit, and who wants that? I talk about the installment situation, and then the second month of the following year where the balance is due if you want to avoid future interest. You can now finally in Canada elect under your functional currency, U.S. dollars, and actually prepare everything in U.S. dollars, which is quite beneficial. Unfortunately, if you don't make that election, and as the rules used to be, because I'm very old, you could have only prepared your Canadian tax filings in Canadian dollars. So absent that election, I'm constantly, being provided information by a U.S. parent, their Canadian subsidiary, and we always go through this. And there's many reasons why you won't necessarily do this functional currency election and or be eligible for it, quite frankly. And so we're always pushing back and going, no, you got to give it to me in Canadian dollars. Sorry, can't file in U.S. dollars. Just so you should know, CRA, that's our Canadian Tax Authority, the Canada Revenue Agency. In dealing with a non-resident has within 4 years, that's your statute of limitations, okay? So that those years are open for 4 years in Canada from the notice of assessment of the original return, somewhat different than the U.S. rules. There's an additional 3 years that they can reassess you. It often comes up in this due diligence when you're doing an acquisition because it's more than just 4 years. It could be up to 7 years that they reserve the right to audit transactions with related non-residents like interest payments and all that other transfer pricing good stuff that Kirk and his group does. Okay. Just some notable differences between the two tax systems between Canada and U.S. In Canada, we call tax depreciation, it's called capital cost allowance, CCA. And unlike the U.S. rules, it's a discretionary deduction, and you can defer deduction and then claim it in later years if it's beneficial. Always blows my U.S. clients away when I point that out to them. In Canada, although we don't have a consolidation regime like you do in the U.S., dividends passing between companies, parent sub, to Canadian companies generally pass free of Canadian tax, so intercorporate dividend. Now, intercorporate dividends in Canada that are received by from a foreign subsidiary by a Canadian company, and you may have that when you do an acquisition of a Canadian company, it may well have U.S. foreign subs. Canada's got a very generous system, unlike the U.S., where dividends from active activities in the foreign affiliates owned by it, which would apply as well to an American subsidiary as a foreign affiliate, that it comes up under our exemption system. That's very generous. The U.S. has still not gotten to that. Most countries do. Just so you should know, taxable capital gains, even for corporations, unlike U.S. rules, you're entitled to a 50% deduction on your capital gains. It's 1/2, and that applies to corporations and individuals. So far as we know, every year we're concerned about them perhaps tampering with that, but that's as it stands. The most often add back when you're actually doing a tax reconciliation for your operations for Canadian tax purposes is meals and entertainment. We only allow you to deduct half. There's other adjustments, but I can't get into that. Not today. Okay, this is a useful slide just to give you a feel. The general federal rate, okay, across the top is 15%, okay, depending, and it's the same for regardless of what style of income that is. And then each of the provinces adds its own, and again, that provincial tax, that's an additional tax, it's not deductible. So if you're doing business in Ontario and it's active business income, as we call it, it's 26.5%. It was as low as 25%, but lately the provincial government has been tampering with it. The general idea under the Canadian rules are that the way the whole system works was based on a 10% provincial rate, because we give a 10% kickback on your federal rate when that's the case, because the actual base federal rate is 25. And then they said, okay, we'll give back 10, allowing the provinces to charge their own 10 to a 25% tax rate. As you can see, most of the provinces have started trying to cheat on that and have raised their rates as well over the years. just so you should know, the basic core dividend withholding tax rate, unlike the U.S. rules, which is 30%. In Canada, it's 25% under your domestic rules, okay? However, as we talk about exhaustively under the Canada-U.S. treaty, and as is the case with most dealing with treaty countries, these rates are more often than not reduced substantially, namely dividends, you're usually down to 5%. And interest, frankly, it was the first time for Canada to have it. The U.S. has had it for quite a while. Interest between related parties, parent, sub, Canada-U.S. is down to 0%. That's a huge transformational change for Canadian tax purposes. We never had a 0% withholding rate on related party interest. Canada does have a 0% withholding on unrelated party interest with other foreign companies, but the U.S. under the Canada-U.S. treaty, 0%. That's a very helpful thing to have. I don't want to show Rich up because he did a phenomenal presentation, but he did talk about the dividend withholding rate coming out of a Canadian ULC, which he talked about exhaustively. Now, the problem with ULCs, as he alluded to, is ULCs, however, are unlimited liability type companies, and he mentioned U.S. blockers. So more often than not, the U.S. parent that does want to set up the ULC will want to insulate itself, though, from commercial exposures, and the most often chosen mechanism for doing so is to use a U.S. LLC as a blocker, because for U.S. purposes, I gather it's fully transparent. There is a problem, though, with ULCs under LLCs, very typical structure, getting into that 0% or 5% withholding rate on dividends, okay? Because under the Canada-U.S. treaty, and they admit it was a mistake, and it's 8 years later, and they still haven't fixed it, but for some quirk of drafting, you may, and you should be mindful in terms of your structure. If you do go with a ULC and you're going to want to have a 5% withholding on the dividend going up, perhaps not use an LLC as a blocker, maybe use an LP, and or your individuals, S corps, things like that work, but just be conscious of how that's structured. These are the various forms you have to use to prove to the Canadian taxing authorities that you're eligible for a treaty. They now ask for that. That for us is new. You guys have always had WBEN type forms over the years. We've recently implemented or introduced these forms. Reg 105 and Reg 102. As Rich alluded to, every person, whether it's a Canadian resident or a non-resident, and that's a tricky one because a non-resident that's otherwise engaged, a non-resident of Canada, a branch in Canada, paying service fees to another U.S. entity, carrying on services in Canada, is equally into this requirement or obligation of a 15% withhold. I should also mention one of the many beautiful quirks of doing business in Quebec, since it has its own tax system for all intents and purposes, there's an additional 9% withhold for Quebec. Of course, same thing, you'll file your return and try to get the 9% back in addition to the 15% that you paid federally. So Quebec also, again, it's a unique, distinct society and it's got all these differences. So the payer is responsible. So it's your Canadian customer that has to withhold the 15%. Now, many times, many large Canadian companies do not know this or are not aware of this, you believe it or not. Now, what may often happen to them is they'll get audited, they'll be obliged to withhold, and then they'll come back to the U.S. Provider of these services years later and say, will you please pay us back the tax that we've now remitted on your behalf so that you can now file a return and get the money back. And we spend a lot of time trying to unwind these types of situations. And frankly, I find the trend lately over the last so many years is there is more and more requirements now. The Amazons of the world and all those other guys are looking to U.S. companies to actually establish a Canadian presence. And when we get into that and we set it up, then we find out, but there was previously all this, nuisance tax that just never became statute barred. Something you should be mindful, though, of if you're operating and you're into this 15% withhold on the service part of your contract, we call it bundled contracts. Try to eliminate, if it's a contract for services and goods, try to distinguish what portion of the value or of the consideration is for the service, because that's the only thing that attracts the 15% withhold. Okay. Likewise, if in an installation contract, a lot of the services on high-tech situations are actually being done in the U.S. and a lot are being done, or a portion are being done in Canada. Try to as well distinguish between those two. It makes life a lot easier in terms of trying to determine what your real withholding obligation is. Because absent that, a Canadian customer that's savvy will just, if you don't otherwise have the breakdown, say, no, I'm going to withhold on the whole unless you tell me differently, okay? So we talk about debundling contracts, specifying what services are being performed out of Canada and in Canada. And we say no treaty relief. Generally speaking, it is very hard these days to get exemptions from this withholding. So you're sort of stuck with it. And more often than not, a lot of these U.S. service providers have just said, bite the bullet. I want to get out of this. I'm going to set up a Canadian subsidiary for the specific reason of getting out of this Reg 105. But otherwise, you file the return and get it back if you didn't otherwise have a business or a permanent establishment in Canada. And I'm just basically lining out exactly what I've just talked to you on the previous thing. Now, I say waivers from Reg are available. Treaty-based, income-based must be in place. I would really say for all intents and purposes, because we try to get these all the time and you have to get them in advance, and they kind of drag their feet. You're usually more often than not able to get them in advance and you're kind of stuck. So that's just the story. Then there's these payroll taxes that Rich alluded to. And again, I think I'm really going to run pretty late here if I don't start. But I leave that to you. One of the most common ones you should be mindful of is it applies to directors. So we talked about residency of the directors of a Canadian company. But a lot of these large Canadian companies, either they set up in Nova Scotia or British Columbia where you don't need to have local directors, or they have directors. They've met the Canadian minimus, the 25% requirement, but they have heavy-duty U.S. directors, and often these meetings are held in Canada. That type of stuff does attract this payroll tax. Of course, that's just the directors. There's also many, many, many situations where you're sending your employees up to Canada, even for a day, where technically you're into it. I will tell you that unlike treaty relief, which I'm finding hard to get under Reg 105, Canada has just introduced, thank God, a blanket election you can make for a lot of what we call casual business travelers. And as long as you have it in place in advance and you only have to file it and refresh it every 2 years, you may be able to get out of it as long as you prove that you're entitled to the relief under the Canada-U.S. Treaty. And that, because see, the downside of this Reg 102 withholding on payroll taxes to U.S. employees or U.S. pay is more often than not, they're going to actually then be able to just claim it as a credit in the U.S. because they weren't technically taxable in Canada. This was just the obligation to withhold. I shouldn't say that you're necessarily going to be able to claim it as a tax credit in the U.S. Alternatively, the individual can file a Canadian personal return and get that tax back under the treaty. So we're just talking cash flow issues more often than not, but you'd rather be compliant. And I allude to that on my previous page. So the employee may choose to file the return of the withholding taxes, and a refund is to be requested. Okay? And there's an entire segment of my practice. It's called expat services that deals with casual business travelers, or we call it global mobility these days. And it is vast because some of these larger American companies are sending up hundreds of employees to Canada on a casual basis, and we got to keep track. They're not going to be permanent here in Canada. They're going to only be here for less than the proverbial 6 months, and they're not really going to become a resident in Canada. And we track all that. Okay. So no discussion would be complete unless I alluded to the voluntary disclosure opportunity. A lot of work, devoted to that. You can make these amnesty things. We're a little concerned because they've announced recently that they're going to make some changes to this voluntary disclosure program, which has been a useful program to have. Because I think one of the unusual things about our voluntary disclosure program is you can actually go forward to them in advance on a no-names basis. So to determine whether or not, give your fact situation, are we actually entitled to some relief here? And I think they're going to maybe tamper with that. Of course, you don't want to if you're doubtful or there's some doubt whether or not you're actually entitled to a refund. You don't want to go in on a full disclosed basis because you've now walked right into it. And what if they turn around and tell you, sorry, you don't qualify, and then you're subject to penalties and interest and all this other stuff. Quickly, this was really Rich's presentation to a large extent, types of entities, corporations, branches, partnerships, employee tax-related concerns, payroll taxes, employee versus independent contractors. Canada has a hard time accepting the idea that Uber drivers are really self-employed. And we're going to probably be the first jurisdiction that's going to go after them in a large way. And the provinces are going to go after them. They're going to want health tax and all these other great things. But good luck to Uber. Anyways, when you invest in Canada, These are all things you've got to be mindful of, how you get the money back out in terms of repatriation of funds back to the States, withholding tax issues on dividends, making sure you fit that 5% withhold, having to comply. Foreign exchange is just a nightmare between the countries. Our rates, as you follow, I'm sure you do, I'm sure you come to Canada to shop and all that other good stuff. I mean, that foreign exchange rate is all over the map. I mean, a couple of years ago, our dollar was actually at par with you guys in recent memory, and now it's down to 75 cents. You have to be mindful of how you denominate your debt in Canadian dollars and US dollars and functional currency elections. It's a full-time job sometimes. And now I'm sort of overlapping a lot of Richard's presentation. The Canadian corporation versus the branch of a foreign corporation and certain benefits to one or the other. I haven't even talked about if you decide to go with a Canadian corporation, a subset of that choice is, do I go with a limited liability corporation or what he referred or talked about, which is the ULC or the unlimited liability company. And the ULC alternative is often used by Americans coming into Canada because of its hybrid nature and your ability to otherwise treat it as a branch for US tax purposes, but also have a Canadian entity for all intents and purposes. So you get out of the Reg 105 and all that other great stuff that I've alluded to before. And more often than not, in fact, British Columbia and Alberta, which are two of the relatively new ULC jurisdictions. Prior to that, there was one law firm, and I won't even mention I can't remember their name, in Nova Scotia that handled all the ULC incorporations in Halifax. And if you ever wanted to do a data dump of all your US-related businesses, you just went to the address of that. It was on Water Street in Halifax. That is how prevalent it is. And as he sort of said, some mystical thing. Yeah, the original Nova Scotia ULC was a little costly to get. It was derived from some ancient corporate law that applied to seafarers and mariners and that somebody actually analyzed and said for US purposes, they're going to consider this a flow-through because it doesn't have certain corporate characteristics. So Nova Scotia had the exclusive on that over the years, and everybody incorporated with this guy in Halifax. And then BC and Alberta joined the game and said, hey, we don't want to lose all this opportunity and corporate fees and filing fees and whatnot. And they did it at a much lower cost, including, and of course, then Nova Scotia was forced to try to be competitive in this regard. There is some competition going on between the various jurisdictions, and they've tried to bring it down. But the Halifax or the Nova Scotia alternative is still relying on that archaic law, and that's still why it's sort of like a creature of, it's not a creature of statute, it's a creature of a lot of common law stuff and whatnot. It's still a little more challenging to set it up in Nova Scotia. More often than not, I see people going to British Columbia for the residency requirement, as Rich alluded to, and it's a lot easier to do it. It can be done very quickly. It's a modern corporate statute. Acquisition planning. I can't tell you how complicating it can be for a foreign acquirer to buy a Canadian target or a U.S. parent to acquire a Canadian target. One thing I can tell you always, and you would be negligent if your advisor did not talk about this, is Canada's got this nifty concept called paid-up capital. Paid-up capital was the original amount put in by the original shareholder, the Canadian target, okay? When you then step in and pay at a big lift as a foreign acquirer, if you do not do something to try to also get recognition for the fact that you're paying a lot more than the historical paid-up capital of the original owner of this thing, you have lost the opportunity to take that amount of money out of Canada tax-free. Canada does not tax distributions. We respect paid-up capital. You can choose to take that out ahead of earnings and profits. We don't have an earnings and profits concept as you do in the U.S. That is a very valuable thing. That is something that you can't overlook. And frankly, if your advisor was not mentioning it, I would suggest you he's actually borderline negligent because it is just so common. In addition, when you're buying a Canadian target, and of course your alternative would be for you to set up a Canadian subsidiary to buy the assets of the target. Well, if you're actually buying the shares of the target, the old proverbial tax talk was BASS, buy assets, sell shares. If you're buying shares, and there's reasons you may want to do so, you got to make sure you set up this acquisition co so you can get the increased lift as a ability to repatriate your money. You've got to do a ton of due diligence on the Canadian subsidiary from both a commercial liability perspective and as well, of course, tax. And that's really the basic difference. But there are certain attributes that may well be worth it, and you'll want to buy it. You may be losses and other things that are there that will be available for you when you go forward. So, yeah, so we talked about that. So the basic repatriation, the conventional, you can't miss it. No withholding tax on a return of paid-up capital. Not sure how the U.S. might look at that. I can't comment on that. As well, if you capitalize it initially with debt, that also can come back free of tax unless you've denominated it in U.S. dollars, in which case you might have some foreign currency exposure. As well, interest on debt. Nowadays, because there's a zero withhold under the Canada-U.S. treaty, that's also a very good repatriation strategy. And then dividends, of course, is a fallback where you try to fit the 5% under the Canada-U.S. treaty. Other things, and this is what Kirk Hesser and his group focus on, are intra-group charges. So manners in which you want to get money out of Canada, ideally with no withholding tax. So it's a tax-efficient way of bringing it back. There's headquarter charges, there's royalty licensing fees, guarantee fees, and all these sorts of things. Oops, and I gather we're going to leave questions to the end and finish my session.
Sorry.
Okay, good morning. Just want to thank Stan and Rich for taking all my time. I'm going to lighten it up a little bit. We'll see if we can move through it as quickly as we can. Obviously, a little bit different focus in terms of what I want to talk about. So just quickly, my name is Steve Spiers. I'm a partner for BDO Canada. I've got a couple different roles within the firm, one of which is I'm the country coordinator from the Canadian firm for the U.S. As a result, in terms of putting people in touch between our two firms, making sure we're doing the right thing. Stan, just briefly, is our international tax partner. So he coordinates a lot of our tax partners in terms of cross-border business. Quick question. How many of you have been to Canada? How many of you have clients or operations in Canada? Perfect. Okay. So I'm a Canadian. I've got a son going to school in University of Chicago, and 3 weeks' time I'm going to become a father-in-law for a U.S. citizen. I'm pretty close here. Okay. We've had really great information so far. I'm going to just talk briefly about BDO Canada and the BDO International, and then I'll get right into some of the Canadian side of things. BDO Canada, we've got offices across the country, all the major markets. We're about $600 million in revenue, I think, this year. We've got an outstanding tax group. Stan leads our international tax, but whether it's domestic, whether transfer pricing, working with Kirk and some of his people. We've got an outstanding group in terms of planning and stuff like that. In addition to that, our transaction advisory group, they do a lot of work with private equity companies working with our U.S. firm. There's more investment coming in to Canada on the private equity, and I'm going to talk a little bit about that today. On the BDO International side of things, we're a clear blue, fifth largest in the world, $7.6 billion in revenue. We're in 150 countries. And then obviously we've got an outstanding BDO U.S. firm that's had significant growth in the U.S. market. We've been talking a lot about risk management over here in terms of the tax, the pitfalls, the French language and things like that. I want to talk a little bit about opportunities, change it up to some extent. Okay. So I know this is a very busy slide. This is really just giving you a sense in terms of Canada, the U.S., economic growth that's taken place. For the most part, we've sort of trended the same way between the two countries. When the U.S. is doing well, Canada's doing well. The last recession that you went through, it didn't hit Canada as quickly. Having said that, it's been a little bit slower for us coming out of that. We're somewhat dependent on the oil through Alberta in terms of how the Canadian economy may look like. But if you look at the annual growth rates, even for 2017 and 2018 between Canada and the U.S., they're identical. So there is a lot of similarity. By far, there's a lot of trade that takes place between Canada and the U.S. And obviously the proximity of the borders and stuff like that. So there's a lot of parallels. The economy in terms of Canada, the largest sectors, manufacturing, financials, real estate, healthcare. The manufacturing, it dovetails a lot with the car industry. If you go into that Detroit corridor into Windsor and as you move into further east in Ontario, there's a lot of cross-border business that takes place on the manufacturing front. Sometimes some people see Canada as more as the natural resources. If you look there, the mining and oil and gas extraction, it's pretty far down on the list overall, but it does have an impact on the Canadian economy. So I mentioned the car industry. We have a very significant technology investment that has taken place in Canada. We were chatting earlier, University of Waterloo, is an outstanding school from the perspective of computers and technology. Google, Microsoft, they've made huge investments in terms of, creating plants and stuff in the Canadian country. Obviously, BlackBerry, which may not be doing as well as it used to be, but that was sort of in that Waterloo area, and it's really a tech hotbed. One, I would say, more significant difference, I would say, is the banking system. The Canadian banking system is really solid in terms of some of the issues, Fannie Mae, et cetera, that took place. A lot of that wouldn't necessarily happen in the Canadian side of things. We've got a small number of very significant banks, a number of which you'll see more and more in the U.S. BMO, I guess, bought Harris a number of years ago, and it's fairly significant, I think, even in this market as well, Rich?
Absolutely.
So, okay, and so just talking specifically a little bit about PE. This is trying to give you a little bit of a sense as to some of the PE deals that have been taking place in Canada. We know that in the U.S., the private equity space is significant in terms of the investment that is taking place in the U.S. PE side has been slow to come to Canada, but it gives you a sense of what's there. We'll talk about deal volume, but typically the size of the deals in Canada are smaller, but the mechanics are very similar. This just sort of gives you a sense in terms of the size of the deals. So there's many small PE deals that will be taking place in Canada. We talked a little bit about industries that are there. Some of the ones that I've seen, aerospace opportunities, technology companies, telecoms and stuff like that. We're seeing those a lot, but there's a lot of manufacturing in particular. Sticking with the deals themselves, so same sort of stats on some of those Canadian PE deals. If you take out some of the top 10 deals, which are quite significant, it transacts to the size of the average deal is a lot smaller. It's around $41 million. So we know that in the U.S. you'll see a lot more significant deals as part of that. On our transfer price or our transaction advisory group that does a lot of the PE, I took a slide from what they had. They've got about 400 professionals worldwide in 45 countries that are doing a lot of the PE deal. Most of them or a significant portion of those are cross-border. The Canadian presence itself, we've got over 440 partners, got over 100 offices, and this is one of the areas that the group's been looking at. A couple of the deals that they've had been highlighted here. I go back to the size of the deal, and I'm not sure the deals that you will see, but 20 to 50 million would be the typical size that we see. And as I mentioned earlier, the private equity investment in Canada has been a little bit slower in terms of how it's come about. Sometimes when you're in that space, you're sort of interested, well, what's the enterprise value to EBITDA? Like, what kind of multiples are you getting? We took 3 of the deals that we were involved with just as a snapshot in terms of what the multiple would be, and took a couple that were not, and sort of put them in terms of what you would consider premium, average, and above premium. There are some great deals that are out there. It's just a matter of making sure that you can, at the end of the day, get the right people. I think that's going to be a big part of it. Who is the typical Canadian owner if you're looking to do some business? Well, yeah, for the most part, they're usually in that 55 to 75-year-old, still very active in the business. It's not uncommon. I'm sure it's very similar in the U.S. There usually isn't a great succession plan in place. Sometimes having the family take over the business is not the best option. For the most part, they're fairly sophisticated from an operational, and there may be some limitation in terms of the financial side of things. Canadians are sometimes seen as often soft-spoken, but there is a high emotional IQ involved. So you really have to know what you're getting into in terms of, in terms of coming up and looking at it as an opportunity and kicking the tires and stuff like that. From a U.S. private equity opportunity, you just got to get through the skepticism that exists. Adapting to the personalities. There's lots of deals to be made, but if you're looking to do the $300 million private equity deal, there's not going to be as many of those. But having said that, there is some significant deals with great upside that exist. The current deal drivers and trends, we're seeing a lot more foreign investment in Canada. It's interesting in the real estate space, I'll say the residential homes, Vancouver, Toronto has just sort of taken off, and a lot of that is foreign investment that has taken place in the residential side, but we're seeing more and more investment overall. Foreign exchange, well, go back a few years, invest in Canada, you get a 35% discount from where the exchange rates were not so long ago. We recognize there's a lot of uncertainty about trade and the tax environment. I think both Rich and Stan talked about that, and knowing where things may land in terms of Trump and some of the initiatives that he has going right now. Deal trends and drivers. The government in Canada is fairly focused on attracting foreign investment in Canada. It was touched on earlier on in terms of what they're trying to do. There is a lot of foreign private equity investors. That's 41% of the total domestic deal activity that's taking place. Key markets, U.S., obviously, a lot from China and Europe as well. We are seen as a safe harbor in terms of entering the U.S. market. It's interesting, I do some public companies as well, and even the number of U.S. companies that have come up to Canada to look at potentially going public because the size of the deal may not have the appetite in the U.S. To go public today. So it may be an easier avenue. Certainly the costs are not as prohibitive in terms of doing that, as well as from the perspective of the regulatory and the SEC. I don't want to say it's easy, but it's a lot easier than it is down in the U.S. So we're seeing more and more of that. It is a competitive private equity landscape in terms of the size of the funds from that perspective. Okay, I mentioned exchange rates over the last 5 years. 2012, we were spot on. This is not right up to date right now, but it's, I think I heard it was about 1.3 was the exchange rate just the other day. But so what does that provide? There's opportunities today. I don't think anything's undervalued, but obviously the FX comes into play from an overall perspective. Deal trends, uncertainty over free trade, we know that exists. We don't know where that's all going to land. I don't think anything's going to change from a Canada-U.S. We are fantastic trading partners. 545 billion trade value that exists between Canada and the U.S. There is tax considerations. I'm not going to get into that, but I think that's been touched on already really well. In your information, I put some information for some of our leaders on the private equity and transaction advisory in the folder. Having said that, I think you've also got contact information for Stan, myself. Hopefully Jeff's is available. Just to the extent that you want to do something, you can always reach out. Maybe it's just even a sounding board on something that you're looking at. It's easy to do. So I guess just a couple last comments. I'm trying to keep it as tight as we can. I'm just going to have a big plug for Rich. The presentation, echoing what Stan said earlier, this is a firm that does a lot of cross-border work, a lot of experience in terms of the international side of things. And, it was a great presentation. And I think, obviously, there's a negativity in terms of the pitfalls that are there, but you have to get into these things with your eyes open so you don't have any surprises. Secondly, Jeff, in terms of suggesting this, Jeff is originally a Canadian that obviously lives in the area, but, I think there's a lot of opportunity that exists in terms of investing in Canada. We're seeing our clients investing in the U.S. as well in terms of growth from that perspective. So with that, I'll pause there and maybe, I don't know if you want to moderate questions or how we want to do it.
By all means, yeah.
Yeah.
I'm sorry we're a little bit over. There's a lot of content covered here today. If you can stick around for questions, by all means. If you have to leave, I understand.
And in that regard, we've got some time this morning if there's anything that you want to talk about at all. But we'll pause there if there's any questions from the group.
Yeah. Peter?
I was reading somewhere about, you talked about the tax in Canada, and for foreign people come in and buy real estate, there's a new tax they're talking about, or it's coming in. Can you just elaborate on what's happening there?
Yeah, so that's really.
Is that specific to Ontario, or?
Yeah, well, Vancouver had introduced its foreign buyer tax about 2 years ago. A lot of Chinese investment. They believed that it's strictly residential, and it was strictly limited to the Vancouver area. And frankly, they found since it was introduced, the market was sort of declined a little bit. There was a little bit of panic and whatnot, but I think everything's gone back to where it's at. So that was the Vancouver solution to what they felt was runaway, and their real estate prices are insane, but they're also limited in terms of where they can build. Vancouver's sort of surrounded by ocean and the mountains and all that other good stuff. And then the Toronto market was heating up enormously, and it too, a couple of months ago, I think April, with great fanfare, introduced its foreign buyers tax. I don't think they've collected one dime of this foreign buyer tax. It's just a message from the government trying to, and I talked to one of the policy guys at the Ontario government, and that too was limited. It was a little broader. It wasn't just Toronto. They included, even where Jeff is from originally, Scarborough, and then what we call the GTA, Greater Toronto Area. Actually, we call it the Golden Horseshoe. But once again, a concern that things were overheating, and a lot of it was speculative foreign buyers who weren't really residing in Canada. As I said, the guy that I spoke to from the Ministry of Finance in Ontario tells you that they don't have a form to collect it. They don't really expect anybody to collect it because there's a lot of easy ways to get around it if you're actually stuck in it. But it's pretty much one home. It doesn't apply if a foreigner buys an apartment block about commercial situations, or non-residential entirely. So that's what that is.
Okay, thanks.
Any other questions?
It's a little bit off topic, but we're doing business in Canada. We signed our first agreement, and we're in the process of signing our second agreement. We do construction. We're a design-build firm. And one thing I'm finding that's different in Canada versus the U.S., and maybe it's just the customers we're dealing with, is that they need to have an agreement put in place before they can get their financing approved. Whereas in the U.S., it's much more complicated financing, and then sign the agreement, you're off to the races. Is that something you've run across as you work with clients that are selling in Canada?
I have, for sure. And I've noted that in various industries, but it's not uncommon in Canada. First, get your agreements in place, and then go to the bank or whatever your financing source is. They want to see everything signed up first. No shortcuts, no pitfalls, and then you get your financing. That's not uncommon.
It's probably a little bit more conservative banking system in some respects, but that's at the same time the banking system is really solid and has been for a long, long time. And maybe that's just, as a result, that's why they've had that approach.
I just had one comment, and one of the areas that I think when a U.S. corporation or U.S. individuals or accountants are looking at Canada, oftentimes you'll think that Canada is so similar to the United States, so therefore things must be the same. Harmonized sales tax, or the GST, is clearly an area that not a lot of people here understand or you might think it's not taxable. You're selling something that's not taxable in the United States. Therefore, well, why would it be taxable in Canada? And you'd come to that conclusion and you have to start operating business and don't realize that you weren't collecting that sales tax. It's a common pitfall. So it's really advisable to get some advice on the harmonized sales tax. And in many cases, if you're manufacturing, you may actually get a refund on the input tax credits that you don't realize you're paying on every invoice for the inputs that are going into whatever you're building up there. Even if if you're exporting to the United States, there's no tax coming down here. So it's an area where people don't realize the rules are different in Canada versus the U.S. related to that, and it can become a big liability quickly. And that's where the voluntary disclosure program kicks in, because there's no statute if you haven't been filing in Canada on the HST. There is no statute of limitations. It'll go back right to your inception of your business in Canada.
And I will caution you that often I have seen where unknowingly you were registered by FedEx or UPS and situations such as that, and then we get involved in these 10-year go-back voluntary disclosures. HST is a very unglamorous area of taxation. If any area of taxation can be glamorous, but that being said, it's the first touch point. Like your goods are coming, and then we can deal with corporate tax. Like we file at the end of the year, 6 months after the end of the year, but that's got to be in place at the get-go. You got to be collecting it and knowing what you're doing right up front.
And I'll just give you one more caution on HST. If you have an HST problem, sometimes an advisor will say, "Oh, you're not filing returns. File the return." That'll trigger an audit. And once you trigger an audit, the voluntary disclosure program doesn't apply. So you might be advised not to. You continue to not file and do it erroneously. Get into the voluntary disclosure and save yourself the penalties and interest the penalties at least that you'd be.
Simply put, if you're sending an employee or somebody up to Canada, you're going to sell into Canada, just get some advice. Just cover your butt at the end of the day. Doesn't necessarily mean you're exposed, but at least you're going in with your eyes open. And, all the rhetoric in terms of transacting in Quebec, it's a different world, but it's doable. You just, maybe you transact in a different place. It's a lot easier.
Any other questions? Well, thank you all for coming. Please fill out the little green sheets because our marketing folks would kill me if I didn't say that. So please fill out the little green sheets. And thanks for coming, and we'll see you in the next one.
And thank you.